Hello and welcome to another session from my solo 401k financial. We're excited to discuss Mega Backdoor Roth Solo 401k at Fidelity made simple. As always, please subscribe to our platform. Please subscribe to us on YouTube, on LinkedIn, on X, as we go live on these channels twice a day, once at 10 a.m. Pacific, 1 p.m. Eastern. Then we're back again at 1 p.m. Pacific, 4 p.m. Eastern. If you have questions or topics that you want to discuss, please chat that over, as we love to discuss questions and topics. We'll get started with today's content that we wanted to bring and share, which again is to Mega Backdoor Roth Solo 401k at Fidelity made simple. As always, the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. So we'll start out with some foundational content, just solo 401k basics. So a solo 401k is a 401k plan that's for a self-employed individual. So in order to be eligible to set up a solo 401k, you need to be self-employed with no full-time W-2 employees. So think like an independent contractor, maybe a solo practicing professional, could be a realtor, could be an attorney, a CPA. Your spouse or business partner can also participate if your spouse or business partner are also working in the same business and reporting their own earned self-employment income. So the key ultimately is you got that earned self-employment income with no non-owner, non-spouse, full-time W-2 employees. Some of the top eligibility considerations are, do I need a separate entity like an LLC or an S Corp? The answer is no. It's certainly possible to set up a solo 401k if you're just simply operating as a sole proprietor. So you do need to report earned self-employment income in your taxes. There's no minimum amount of earned self-employment income that's needed. So examples of earned self-employment income would be Schedule C. For example, if your business is taxed as a sole proprietorship. Could be someone that doesn't have a formal legal entity, right? They just get a 1099 and file a Schedule C under 1040. Could be somebody that does have an LLC, but it's a disregarded entity, right? They don't file as an S Corp, for example. Other types of self-employment income would be W-2 wages from your business taxed as an S Corp, or even income reported on a K-1 in the case of a business that's taxed as a partnership, specifically line 14 of the K-1. Your spouse or business partner can participate if your spouse or business partner is also working in the same business and reporting their own earned self-employment income, such as their own W-2 or their own Schedule C. You can have a solo 401k even if you have a W-2 job, a day job, as long as you're reporting some earned self-employment income. Even if you participate in your W-2 employer-sponsored plan, that won't stop someone from setting up a solo 401k based on their side income, right? They might have a side hustle. As long as, again, they're reporting that earned self-employment income with no W-2 employees working for their business. So one of the top reasons that customers sign up with us is the ability to make Mega Backdoor Roth Solo 401k contributions. So in order to set up a plan that allows you to make Mega Backdoor Roth Solo 401k contributions, you first have to be eligible. So that's, again, self-employed with no full-time W-2 employees. And then you have to have a plan that allows for Mega Backdoor Roth Solo 401k contributions. So there are a lot of basic solo 401k plan providers like Fidelity, Schwab, etc., that offer a solo 401k plan, but it doesn't allow for Mega Backdoor Roth contributions. But you can have a plan through a company like us that does allow for Mega Backdoor Roth Solo 401k contributions, but still have your account at Fidelity. So the key is that you work with a provider that offers a plan that allows for voluntary after-tax contributions and then in-service distributions. Because when you make a Mega Backdoor Roth Solo 401k contribution, you're really making a voluntary after-tax contribution, because the voluntary after-tax contribution limits are much higher. As we'll see in these slides that follow, they're much higher than the Roth Solo 401k contribution limits. And then you have to move the money from the voluntary after-tax solo 401k account to either a Roth solo 401k or a Roth IRA. That's why you have to have both pieces, right? You have to allow for the after-tax contributions as well as that in-service distribution. And then, of course, it's going to make sense to work with a company like ours that's going to be very hands-on in helping you through the required steps. For example, you need to have multiple sub-accounts, a separate voluntary after-tax account, and then a separate Roth account. So we assist, for example, with establishing the required sub-accounts. These accounts can be at Fidelity. So even though Fidelity offers their own basic plan that doesn't allow for mega backdoor Roth contributions, they're still happy to open up accounts for someone that has a third-party plan like our plan that does allow for mega backdoor Roth solo 401k contributions. So you can have the plan that allows for the contributions that you want, but have the accounts at Fidelity where you want them. And then again, you're going to want to not only work with a provider that allows for mega backdoor Roth contributions, that offers a plan that allows for mega backdoor Roth solo 401k contributions, as well as assisting you with establishing the required sub-accounts, but also providing the ongoing compliance support. So as we've learned, making a mega backdoor Roth solo 401k contribution is a two-step process. You first deposit those funds into the after-tax account before they get moved to either the Roth solo 401k or Roth IRA. So even though that first step of making the contribution is not reportable on the personal or business tax return, the second step, when you move the money to either the Roth solo 401k or Roth IRA, is reportable. It's reportable on a Form 1099-R. So we prepare that Form 1099-R as an optional free service for our customers. In other words, no additional charge. So you're going to want to work with a provider, again, like us, that offers that ongoing compliance support, including the required 1099-R reporting. So how do I convert? Well, if the accounts are opened up at Fidelity, they can be transferred electronically from the after-tax account to either the account for the Roth solo 401k or to a Roth IRA at Fidelity. It could be a new Roth IRA at Fidelity or a pre-existing Roth IRA at Fidelity. What are the steps? Well, first step is to open the Fidelity brokerage account for voluntary after-tax solo 401k funds. And again, we're very hands-on in helping our customers through that process, helping them understand the steps, helping them understand the contribution rules and how it applies to their situation. In other words, how much they can contribute as a voluntary after-tax solo 401k contribution based on their income. And we'll go through an example here in a moment. But so that first step is going to be, again, to open the account, make the contribution. Step two, convert to Roth. So it can either go to a Roth solo 401k, in which case a second account would be needed at Fidelity for the plan. So a second account opened up at Fidelity, a second brokerage account opened up at Fidelity under the name and EIN number of the plan for Roth funds, or transfer from the voluntary after-tax solo 401k account to a Roth IRA at Fidelity. Again, it could be an existing account or it could be a new Roth IRA account. And then lastly, step three, provide us the information that we need to prepare the 1099-R. You can easily and quickly find the links to the forms that customers use to give us this information at mysolo401k.net/forms. You'll see that there's one form for those that are transferring from the after-tax solo 401k to a Roth solo 401k, and another form for those that are transferring from the after-tax solo 401k to a Roth IRA, right? And then we capture that information. It's put into the queue for us to issue that 1099-R, which we handle as an optional free service for our customers. So we talked about how we help customers understand how much they can contribute to the solo 401k. When you make a mega backdoor Roth solo 401k contribution, you're really making a voluntary after-tax contribution. So in order to know how much you can contribute, you need to know what that voluntary after-tax contribution limit is. So the voluntary after-tax contribution limit is 100% of your self-employment compensation, dollar for dollar, up to the overall limit, right? So your self-employment compensation is going to depend on how your business is taxed. For example, for a business taxed as an S corporation, self-employment compensation is equal to the W-2 wages that you receive from your business taxed as an S corporation. Whereas if your business is taxed as a sole proprietorship, self-employment compensation is equal to line 31 of Schedule C. In other words, your net self-employment income reduced by 1/2 of your self-employment tax. We have a calculator on our website that'll run these numbers, or that'll run that number of determining 1/2 of self-employment tax. Now, you also have to consider the overall limit. So if you are making other types of contributions, right, our plan not only allows for these mega backdoor Roth contributions, but also allows for pre-tax contributions or Roth contributions. Some individuals, they first want to maximize the pre-tax benefit to reduce their income now for the year for which the contribution is made. And then whatever's left, they want to contribute as a Roth or a mega backdoor Roth contribution. Whereas others just want to focus on the voluntary after-tax contribution. And that's fine. Either approach is fine. But if you're going to make multiple types of contributions, you've got to consider that overall limit. So the sum of all the different types of contributions that are made to the solo 401k, whether employee, employer, and or voluntary after-tax, cannot exceed the lesser of your self-employment compensation or the overall limit. Other additional compliance points would be that the voluntary after-tax contribution limit doesn't go up if you're age 50 or older. So of course, if you're age 50 or older, you can make what are called catch-up contributions, and our plan supports that. But if you're going to make catch-up contributions, they're not made as voluntary after-tax contributions. Instead, those are made as employee contributions, either pre-tax or Roth, directly to those pre-tax or Roth accounts as applicable. Additional points of consideration, again, are if you're making voluntary after-tax contributions, these are deposited into a separate sub-account. This is why clients will have multiple sub-accounts for their same plan. For example, one account at Fidelity for pre-tax solo 401k funds, a second account at Fidelity for Roth solo 401k funds, and then a third account at Fidelity for voluntary after-tax solo 401k funds. Lastly, it's noteworthy that the voluntary after-tax solo 401k contribution limit is not impacted by contributions made to another retirement plan. So as we talked about at the outset, in terms of eligibility, the fact that someone has a day job 401k, right? So they have a day job and they participate in their 401k at their day job is not going to prevent them from setting up a solo 401k based on their self-employment income. So even if that person maxes out their employee contributions to their day job 401k plan and receives a match from their day job employer, that won't reduce their ability to contribute after-tax contributions to the solo 401k. Now, the one exception to that general rule is the 403b exception. So all contributions made to the 403b, whether employee and or employer, together with any contributions that the individual wants to make to the solo 401k, the sum cannot exceed the overall limit. So let's apply that or those contribution rules to a scenario. Let's assume that we have a self-employed business that's taxed as an S corporation, or could be a C corporation, where the self-employed individual is under 50 years of age, does not make contributions to another plan like a day job plan. Their goal is to maximize Roth and or voluntary after-tax contributions, and they have $100,000 of W-2 wages from their self-employed business, again, taxed as an S corp or a C corp. So how much can they contribute to the solo 401k? Well, they could contribute 100% of their wages, dollar for dollar, as an employee contribution. For example, $23,500 for 2025. They're not interested in making employer pre-tax contributions, so they could just decline to make those and then make the difference up to the overall limit, right? Because they have $100,000 of W-2 wages as a voluntary after-tax contribution. For example, $46,500 for 2025, and then move those funds from the after-tax account to the Roth account. Again, these accounts can be at Fidelity. That's the most popular brokerage option. So at the end of the day, they're going to have $70,000 in contributions that end up in their Roth Solo 401k account for 2025 at Fidelity. And then, of course, they would just let us know about those contributions, or I should say about the transfer from the after-tax to the Roth, so we can capture the information needed for the 1099-R. So when is the deadline to make contributions? Well, the deadline is going to depend on two factors. When did you set up the plan, and how is your business taxed? So for those that signed up with us or set up a plan somewhere else that was then restated to our plan, they set up a plan somewhere else before the end of last year, or they signed up with us before the end of 2024, they would have preserved the ability to make all types of contributions until their business tax return deadline, including any timely filed extension here in 2025. So if their business is taxed as a sole proprietorship, really their self-employed business tax return deadline is the 1040 deadline. So if they filed an extension for their 2024 1040, that would give them until October 15th to make all types of contributions for 2024, right? Assuming that they established a plan either with us or somewhere else and then restate it to our plan. They set it up somewhere else before the end of last year or signed up with us before the end of last year, and they filed an extension for their tax return. They'll now have until their 2024 business tax return deadline, including any timely filed extension. So if their business is taxed as a sole proprietorship, October 15th. If their business is taxed as an S Corp, same scenario, right? They signed up with us before the end of last year. Now it's driven by the S Corp deadline, which is September 15th if they filed an extension. Or partnership, same thing, September 15th if they filed an extension and set up the plan before the end of last year. And then finally, if their business is taxed as a C Corp and they signed up, they set up the plan before the end of last year and filed an extension, they would again have until the extended deadline for the 11/20, i.e. October 15th of this year, to make all types of contributions for 2024. Now let's talk about a different scenario. Let's assume that they didn't set up the plan with us or somewhere else before the end of last year. And now they're setting up the new plan here in 2025. So if they want to be able to make mega backdoor Roth contributions for 2024, they could still set up a plan here in 2025 and make those 2024 mega backdoor Roth contributions, i.e. voluntary after-tax contributions, as long as they filed an extension for their 2024 business tax return and set up the plan with us in time to make those contributions, those after-tax contributions for 2024 by the extended business tax return deadline. So if their business is taxed as a sole proprietorship, they didn't set up a plan before the end of last year, but they want to make mega backdoor Roth, i.e. voluntary after-tax contributions for 2024, they can still set up a plan here in 2025 as long as they filed an extension for their 2024 1040 and then make contributions by October 15th. Likewise, if the business is taxed as a partnership, if they filed an extension for the 1065, that would give them until September 15th of this year to set up a plan with us and make at least the 2024 voluntary after-tax contributions. Same thing if the business is taxed as an S Corp and they filed an extension. Same thing if the business is taxed as a C Corp and they filed an extension for that 11/20. The pattern continues. Well, thank you so much for joining. If you found this to be helpful, please like on the platform that you're watching on. Please share with others that you think might find it to be helpful, as this will help us to get the word out to other self-employed individuals just like you who might find it to be helpful. We really appreciate that. Please continue to engage. You can also participate in our community. It's totally free to join. All are welcome. Where you can post in the forums. You can check out our library of videos and webinars. But until next time, we'll be back again tomorrow. Please subscribe and you'll get the notifications and we can continue the conversation. Thank you so much, everyone.